credit unions who may service a lot of their own loans, and I know uh, sometimes the credit union sells them to a different end lender, but some loans you guys will service. You guys get to do different things. So typically, could you speak on when you're going to service a loan, what's required, and then overall, what do you typically see might be required when somebody's self-employed if it's not going to be serviced? If that's a question that makes sense for self-employed.
Sure. Yeah, so servicing is a whole different animal. So I could sell a loan. So right now what we do is we sell all of our conventional FHA and VA loans to other companies, okay? However, we could, and we are actually in the process of signing up to sell directly to Fannie Mae and Freddie Mac on our conventional loans. Um, and then servicing them ourselves. Now, the important thing to understand is on any loan that's sold to FHA, VA, or Fannie or Freddie, so basically most of the standard loans in the country, the servicing is just taking the money and giving it to the investor, whether that's the company that originated it like us or somebody who bought the money. And they get a few dollars a month. It's not very much that they get for doing that. So that's not a portfolio loan. So there's a totally different thing there. When I say, hey, we're going to hold on to your loan. For example, a lot of times we'll split a loan into two because we can get better pricing by avoiding the PMI sometimes. And we do service that second loan because that's us lending our own money. Okay. But if we sold a loan to Fannie Mae and then retained the servicing, all we're really doing is collecting the payment for you and then sending that payment on to the end investor who put up the money for the loan, which is it gets packaged and sold as a bond in the secondary market. Okay. Um, as far as self-employed goes, um, that can be difficult, as I'm sure you know, right?
Yeah.
The first thing we do is we try to go with an investor or find a way to do it with just 1 year of tax returns. Because with 1 year of tax returns, we don't see income trending. The problem when we need to use 2 years is when income starts trending downwards, there's a lot of investors that won't let us proceed. And there's different thresholds by how much they can decrease. But again, if we only have the 1 year of tax returns, then we're golden. So let me give you an example. Freddie Mac and Fannie Mae, usually if you've been self-employed and with the same business, not changing the structure of it every 2 years, like some people like to do, but if it's been the same business for at least 5 years and you have good credit and down payment, when we run it through their underwriting system, it'll tell us we only need 1 year. And we have the 1 year. That's usually when we have the best chance of getting an approval for self-employed borrowers. Obviously, when we need the 2 years, like for jumbo loans, almost always require 2 years. There can be problems when the income is declining. If it's, stable or increasing, it's not a problem. So sometimes what we have to do if we can't qualify somebody based on their tax returns, whether it's because of declining income or just not enough income that's been reported on the tax returns, is there's alternative documentation loans. Right now, the most popular one is what's called a bank statement loan, where basically we get your last typically 12 to 24 months of bank statements, and these can usually be personal, like if you file as a sole proprietor, or business bank statements if you file as a corporation or an S corp. Typically, we can take kind of the average over 12 or 24 months, and then there's an expense factor, but then that gets used as income because the reality is there's a lot of things that people write off on their taxes and rightfully so. But, from the mortgage company perspective, when we look at the tax returns, we have to look at what you're actually reporting the government as your income, not just the revenue generated or the gross sales receipts.